In today's course, Money, Banking and Financial System, we're going to do chapter 1, which is about introducing money and the financial system. In today's class, we identify the key parts of the financial system. We'll also look at an overview of the financial crisis of 2007 to 2009 and during the COVID period in 2020. We'll also be explaining the key issues and questions concerning the financial system. The three major parts of the financial system are the financial assets, financial institution, and the Federal Reserve and other financial regulators. Financial assets represent a claim on someone else for a payment. It's just like we have an asset, then we have the finance. So, usually we say an asset is anything of value owned by a person or a firm. So saying a financial asset, it means that it's also an asset, but this time it represents a claim on someone else for a payment. Now, the key component of financial assets includes security. And a security is a financial asset that can be bought and sold in a financial market. And for financial markets, it's any place or media or channel for buying or selling stocks, bonds, and other securities. So moving on, we try to look at the different types of financial assets. That is the categories of financial assets, which is money, stocks, bonds, foreign exchange, and securitized loans. In the next slide, we try to look at the difference. We briefly explain. Money is anything that is valuable and is generally accepted in payment for goods and services and for deferred payment, that is for pay off debts. When we talk about money, first of all, who supplies money? We have to also look at money supply. Money supply is the total quantity of money in the economy. Usually, the government of a country actually regulates the money supply. How and when this should be done, it's by the government. They usually do this through the Federal Reserve, and they also set up other financial regulatory bodies. The main regulator of money supply, the main institution in charge of money supply, are usually the central banks of a country. Stocks are financial securities that represent partial ownership of a corporation, and they are also known as equities. And when we talk about stock, we can also say shares. Shares are also stock, like buying shares and becoming a shareholder of a company. Now, for those that are shareholders of a company, they usually get payments, and this payment is known as dividends. When company make profits after covering the costs of their business activity, cost of production, and any other costs involved, and also removing the retained profits. Profits they can always fall back in terms of them needing funds. They share profits, and this profit they share to their shareholders is known as dividends. Then bonds, it's a financial security issued by a corporation or a government that represent a promise to repay a fixed amount of money. Now we also have interest rate. When we mention about interest rate, it's actually the price of borrowing money. Interest rate is the cost of borrowing funds or the payment we made for borrowing or lending funds. usually it's the interest rate are expressed in a percentage. Like usually the CBN, like I told you, in money supply, the CBN regulates the money supply, and they also regulates the rate. They usually give a range based in percentage of the interest rate that should be given to borrowers. They give it to other financial institutions that act as intermediary between the borrowers and the savers. Now we're going to look at foreign exchange. Foreign exchange is actually foreign currency. It refers to units of foreign currency, and for those investors or business people who do business, international business, they first of all have to convert their money into the foreign currency at which they want to buy goods, services, or foreign assets. And how do they do this? The banks helps them achieve this. The banks are the largest buyers and sellers of foreign exchange. They ensure that foreign currency transaction, it's made easy between for investors, just because because the banks engage in foreign currency transaction on behalf of investors and the business firm. They ensure that the largest buyers are the investors, that the investors are able to exchange their domestic currency for a foreign currency which they use to buy their goods and services or foreign assets. Now we're going to look at securitized loans. Securitized loans, it's the process of actually securitizing loans. That means making financial assets that are not tradable into a tradable securities. So securitization is the process of converting loans and other financial assets that are not tradable into tradable securities. And when they convert them into tradable securities, it now becomes, that means, a loan which they give to borrower. The borrower now has to take the loan and use, and in returns, that means in payment for getting that fund for use, they pay interest rate. And that interest rate, it's is based on the amount and terms and condition at which the borrower has taken, has borrowed the money. So when a borrower takes a loan, the loan becomes a financial liability to that borrower, for the borrower, and this obligatory on the borrower to fulfill is part of the agreement based on the terms and condition, and pay back the loan. For financial institutions, the financial systems actually helps the savers and the borrowers. It's a middleman between the savers and borrowers. It helps collect money. It collects money from savers and give this money out to borrowers who wants to borrow the money. So these financial institutions are banks and other financial intermediaries. Now, the banks, when they collect money from savers, like we all have accounts, okay? Majority of us, we have accounts. We take our money to the banks for safekeeping, and for the money we usually feel the money is secure them. While the money is with the bank do not actually take the money from the savers and lock them up in a box or in a safe. They give this money out. They make this money work, they take them out and they give it out to borrowers who pay back the bank with interest rate. So when banks do that, they call them, they become financial intermediaries. So in financial intermediaries, in financial market, we have financial intermediaries, and the banks, they are the financial intermediaries. So for financial markets, there are two types of flow of funds in financial market. We have the direct and the indirect. The indirect finance is when the banks act as financial intermediaries. The money that is given to them, they just don't leave the money idle. They take this money and they give it out to borrowers, to people who need them. Usually the household, the government, and business people, they save this money, and this same group of people, they also borrow this money from the financial intermediaries. So when the borrowers the borrowers and the savers, the savers take the money to the bank, and these banks, they give to the borrowers. The bank is acting as a financial intermediary, and that is indirect finance. That means fund flow from lenders to borrowers indirectly through financial intermediaries such as bank. That is indirect finance. Then we also have direct finance in financial market. This is when there is direct flow of funds from savers to borrower. That means there won't be presence of a bank there. Okay, now this explains what I've been saying, where I said the household, the firms, the government, they give the money to the banks, which is the financial system for safekeeping. Okay, and these same banks, which are the financial intermediaries, they act as the financial intermediaries. They borrow this money out to both the firms, the government, and the household. So they actually control the flow of funds between the savers and the borrowers. The financial system sends funds from savers to borrowers. Borrowers send returns back to savers through the financial system. Savers and borrowers include domestic and foreign households, businesses, and government. So it's a cycling process. They save, they borrow out, right, through the financial intermediary, which are the banks. So moving on, we try to look at the major player in the financial intermediary, the commercial banks. The commercial bank are the most important financial intermediary. They take deposit and use them to make loans. Okay, and also firms and governments, they actually borrow this money from the bank, and also, apart from borrowing, they also save. They save and borrow with the banks. And firms really rely on banks to meet their short-term and long-term needs for credit, because the people that borrow most are investors. They mostly majorly borrow from the banks, because they are always investing, and they pay back, invest and pay back. So they rely on banks to meet their short-term and long-term needs for credit. Let's look at the rise of peer-to-peer lending and fintech. Before now, during from the period of 2000, before 2007 to 2009, many borrowers could actually go to bank and easily have access to loans, but over time they started defaulting. They defaulted on their loans during the financial crisis caused by the I think, was it not the house bubble? So the federal government regulators began pushing banks to tighten their loan guidelines, that they should so that businesses and households could could not have, they have to meet these guidelines and qualify for loans. So it was not as easy as the way it used to be. It became more difficult to actually have access to loan from the bank. Then came up during this period, then the peer-to-peer lenders came up. The peer-to-peer lenders are lenders such as the Lending Club, Prosper, and Sophie. These are just examples here. Like in other parts of the world, there are other lending, there are other peer-to-peer lenders. They feel the demand for loans by individuals, businesses, and financial firms. They made it easy, and because during the time the guidelines to borrow loans from bank was become more, it was difficult. The guidelines were tightened. These peer-to-peer lenders came up, and people were using it, and they borrowed and were able to borrow loans. Like I said, these peer-to-peer lenders are in every part of the world with different names. These are just examples in the USA. They usually use the financial technology. That means they use apps and smartphone. In short, they rely heavily on smartphone technology in the loan application process. However, in 2020, in the period of COVID-19, these firms became less profitable than investors expected because this was because of their inability to reliably predict the creditworthiness of borrowers. It's not as if they could not actually assess their borrowers. They could actually give a good assessment of them, but it was not reliable, and it was not efficient. It was not good enough, and these firms became less profitable. So moving on to the investors. So moving on, we're going to look at non-bank financial intermediaries. For non-bank financial intermediaries, we have savings and loans, savings banks, and credit unions. They just take deposit and make loans, but they are legally different from the banks. The first is insurance company. Insurance companies collect premiums from customers and they invest these premiums. They invest these premiums so that they will be able to pay their customers at the time when they will be making claims. And they also use this funds got it from the investment to also cover for their running cost. Because as we have different types of insurance. We have car insurance, we have house insurance, we have fire insurance, we have accident insurance, we have even life insurance. Over time, people who are registered with this insurance company that have taken up insurance package, they pay premiums even though what they've insured themselves against has not happened. Over time, years, they just pay premiums. This money is not kept by this insurance company. What they do is that they invest this money so that they will be able to cover for the claims made by these customers later on, because usually claims paid by this insurance company are usually bigger than the by the I mean these claims are usually bigger. The claims that are paid to them are usually bigger than the premium they've paid over time, for over a period, spread over a period of time. Usually this insurance just pay them after a period, after their paper documentation in regards the premium paid and what they've insured themselves about. The insurance company pay these customers, and the claim is usually very big, and most times one time they pay them one time. So how this insurance company are able to do this? Because they invest this premium over the years. So Another non-financial intermediary is investment bank. Investment banks assist firms in underwriting stocks and bonds. That means they sign and accept liability under usually sometimes under the insurance sometimes insurance policy. That means the investment bank will just they assist the firms to or individuals take on financial risks for a fee. They just take the financial risks for a fee, and there are different types of investment banks. Example are the Goldman Sachs and Morgan. These are examples here, and like I had earlier mentioned, in other parts of the world we have different names for this investment bank. Then moving on, we're going to look at pension fund. Pension fund is another non-bank financial intermediary. These are funds that are collected during the active working life of workers, employees, and when they are retired, the benefit is paid to them. We also have the mutual fund and exchange traded funds. This is obtained this is by selling shares to investors and invest the money in a portfolio. And usually the portfolio is a collection of assets such as stocks and bonds. The hedge fund is different, though it's similar, but it's different in a way, because hedge fund is usually backed by wealthy investors, and it's also the turnover is also bigger. At the same time, it's a riskier investment. It's very risky compared to the others, the mutual funds and the traded funds. Now let's look at financial markets. Like what we are used to, that financial markets have been physical places, but as of today, most security trading takes place electronically, and this is just links linked by computers, and this is called over-the-counter trading, like the Nasdaq. Then in financial markets, we have the primary markets, and we also have the secondary market. Okay. The primary markets are where stocks, bonds, and security are sold for the first time, and the secondary markets are where existing securities are sold. They already existing and they are sold. They are sold in the secondary market. This is a graph. We're going to take a look at this graph, and we're going to look at the percentage of household wealth. What do people do with their savings? What do households do with their savings? The graph actually shows the significant changes of household holdings of financial assets between 1978 and 2019. The red, or is it brown? Okay. Okay, permit me. Okay, the brown and the blue, we have the brown and the blue color. The brown is 1978 and the blue is 2019. Okay. Now if you look at it, this is the vertical axis is labeled in percentage of household wealth from 0 to 35%, and we have the horizontal axis with list of various categories, which is bonds, corporate stocks, equity on incorporated businesses, deposits, mutual fund shares, pension entitlements, and other. So if you're taking a look at the graph, you see we have supply by financial market, supply by financial intermediaries. So At various times between 1978 and 2019, households have increased their holdings of bonds, okay, corporate stocks, mutual fund shares, and pension fund reserve. Okay, and on the other hand, they have decreased their holdings of equity in unincorporated businesses. Okay, this is 2019, and they've also that means as in such as in partnership and sole proprietorship, they decrease in this. And the bank deposit, these are deposits. Their bank deposit was higher in 1978, and it also decreased. It's decreased in 2019. You look at this and this, they are decreased compared to 1978. It was very high. Now coming to corporate stocks, it's high in 2019. They are buying more of corporate stocks. And pension entitlements, okay, it's higher. That means they got involved more in pension, paying of pension and collecting of pension. They're contributing to the pension fund. So it was high in 2019 compared to in 1978, and these corporate stocks is higher in 2019 compared to 1978. So this is for the graph. Over time, people change, and they change in what they do with their savings. Now moving on, we're going to look at the Federal Reserve and other financial regulators. For Federal Reserve, the central bank of every country is in charge of this, and other financial regulators are like the Security and Exchange Commission, the Federal Deposit Insurance Corporation. We also have the Central Bank of the United States. We have the Central Bank of Nigeria. We have the Central Bank of Kuwait. All of these banks, all of these countries, they have their central bank. They regulate, and they are the number one in the Federal Reserve System. They manage this. So we also have the federal agency that regulate the financial system. For the US, we have the Consumer Finance Protection Bureau, and we have, I think, EFCC in Nigeria, and other countries, they have different names which they have given to their federal agencies that regulate their financial system. So I will really encourage you to carry out a mini research, try to find out about the Federal Reserve and other financial regulators of your country or the place you reside. It's really going to expose you in this regard, in this topic. You see how they operate and what they do, where they were established, when they were established, how they were established. So the Federal Reserve is the central bank of the United States, for example, and this was established in 1913 to deal with banking problems, and they are also known as lender of last resort. Who do they lend to? They lend to these commercial banks. Sometimes these banks they do not have enough funds. They do not have enough retained funds to actually borrow out to people, to firms or government, okay, government official or government, let me say government. So when they don't have this, they lend from the central bank, and the central bank gives them. And this lending process is the way they regulate the money supply, okay. Sometimes when they want this money to be there should be they want increase the money supply, the money in circulation, they actually lend them a lot. And when they don't want this, they withhold. Okay, this is what they do. Then we are also going to look at the Federal Reserve, which are the central banks. They are also responsible for monetary policy, which refers to the actions to manage the money supply and interest rate to pursue macroeconomic policy objective. Like in the United States of America, the Fed is divided into 12 districts. So, like I had mentioned just now, that you should carry out a mini research about the Federal Reserve and the regulatory the Federal Reserve and the regulatory financial regulators in your country or where you reside. Find out and see and know how they operate. Now, what does the Federal Reserve also do apart from being responsible for the monetary policy? They also the federal funds rate is the interest rate that bank charge each other on short-term loans. They regulate the rates that which not just the money supply but also the interest rate. This is the Federal Reserve System of the USA. It's divided into 12 districts, each of which has a district bank located in the city showing on the map. Okay, now we move on. We're going to look at other things the financial system do. The financial system provide three services to savers and borrowers. They provide risk sharing, they provide liquidity, and they provide information. Now, in the risk sharing, it said that they do this by diversification. This is to reduce the savers' risk. They do it by diversification. Diversification is the splitting of wealth among many different assets to reduce risk. Means you invest in different assets so that you don't you are not faced with so much risk. Like they tell you, don't lay all your eggs in one basket. Okay, they try to split all of the wealth and invest in different assets. Then they also allow savers to spread and transfer risks by holding different assets along with other savers. Means sharing, risk sharing. Risk sharing is they invite other investors, and so means they allow savers, I mean people who save that keeps money with them, they diversify their money and into different assets with other savers. So by so doing, they are able to reduce the savers' risk. You know, risk is the chance of the value of financial asset will change relative to what you expect. Means you probably they just help prevent you losing your financial assets. Then another thing they do is liquidity. They provide liquidity. Liquidity is the ease which an asset can be exchanged for money. So when financial market intermediaries financial market intermediaries help make financial assets more liquid, and they also provide information. You know, the savers, the borrowers, they need information. They work with information because information is fact. Usually the borrowers, when money is when interest rate is high, the borrowers, the people who borrow money do not want to borrow because the interest rate is high. Usually the interest rate is regulated by the central bank of the country. So when it is high, people do not want to borrow. So they always want to, this information of interest rate is high, it's not high, this is disseminated by the intermediaries. They tell the interest rate at a particular point in time, and the borrowers need this information because it's fact, and to predict their expectations of return on their financial assets. They also, and when this interest rate, for example, when the interest rate is low, the borrowers, people who borrow money, want to borrow because it's low, right? They want to borrow a lot, and these are information. These informations are very useful to them to determine when to borrow, when not to borrow, okay, and also be able to know their expectation of returns on their financial assets. So financial market convey information to both savers and borrowers by determining the prices of stocks, bonds, and other securities. Now we're going to look at, we are going to briefly discuss the extent to which securitized loans embody the key service of risk sharing, liquidity, and information. So securitized loans are loans that have been bundled with other loans and resold to investors. They are both financial assets and financial security. Now, do these loans provide risk sharing, liquidity, and information? Yes, they provide this service in three aspects. Okay, when a mortgage is securitized, the buyers jointly share the risk of a default, and they can also, and these loans can be resold and so has a secondary market value. A securitized loan has a secondary market value, can be resold. When loans are securitized, investors rely on the bank to gather the necessary information. So we're going to look at an overview of the financial crisis of 2007 to 2009 and 2020. So a financial crisis is a significant disruption in the flow of funds from lenders to borrower, and the financial crisis of 2007 to 2009 was caused in part by housing bubble of 2000 and 2005. And when this happened, it brought about financial crisis, and a lot of borrowers defaulted. They were not able to meet up with their fulfill their financial liability. Now, what is a bubble? A bubble is an unstable increase in the price of a class of assets like houses. Okay, like this bubble cost in 2007 and 2009. Financial crisis of 2007 to 2009 was caused by housing bubble. Now, bubble causes overly optimistic expectation, and this made it easier for families to borrow money to buy houses. And after because bubbles are not real, okay, they are not real. So when there's bubble, people they are very optimistic. Oh, it's going to go well, it's going to be so nice, it's going to be very profitable. And what do? They borrowed they'll go ahead and borrow to invest, like this housing bubble. So when families became very optimistic, they borrowed money to buy houses. And what happened after borrowing money? The housing prices crashed because it was never real, it was all bubbles. And investment bank also participated in the mortgage market by bonding and selling mortgage-backed securities. Standards for obtaining loans were greatly losing because a lot of people were borrowing. So that many mortgages were being issued to subprime borrowers with flawed credit histories. Adjustable rate mortgages allow borrowers to pay a very low interest rate. But in 2006, housing prices declined, leading to rising defaults and a sharp decline in the value of many mortgage-backed security. And a lot of families could not pay back their loans. Now, the deepening crisis and the response of the Fed and Treasury. What did they do? In October 2008, Congress passed the Trouble Asset Relief in USA, under which the Treasury provided funds to commercial banks in exchange for stock in those banks. And many policies were changed, okay, more to many of the Fed and Treasury during the recession of 2000 were controversial because they involved the moral hazard problem. Financial firms, especially large ones, make riskier investments if they believe the government will save them from bankruptcy. Partial government ownership of financial firms or precedented intervention in financial markets. So many fear that the first action might reduce its independence. So for COVID-19 pandemic, which is in March 2020, many mayors and governors responded to the COVID-19 pandemic by closing non-essential businesses. And savers and investors became reluctant to lend money because they worried that borrowers might have difficulty repaying loans. In response, the Fed revived some of the lending programs or lending facility using during the 2007-2009 financial crisis and set up some new facility. And Congress passed a 2009 trillion spending bill under the Coronavirus AIDS Reliefs and Economic Security Cares Act, including the Paycheck Protection Plan, loans and grants to small businesses. A lot of countries got involved in this. Many countries they bailed out the the economy by putting a lot of funds. Then the federal also launched the Main Street lending program to make loans to medium-sized firms. So that is the end of today's class, and I hope you will be able to tell the 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 central bank of your country and the financial regulators of your country or where you reside, and how were they able to bail out households, firms during the COVID-19 period. Thank you.